We've got Rajesh Gopinathan and Ajoyendra Mukherjee right here with us. Good afternoon, good morning rather, gentlemen. Rajesh, this fourth quarter, in some sense, you got saved by a control on costs, which helped benefit your margins, and higher other income, which helped you beat the profit expectations, so to speak. What's the outlook for the first quarter of FY16?
I would characterize the margin performance slightly differently.
Okay.
We have actually had the second sequential quarter of realization improvement. We have had about an 80-90 bips improvement in realization. We have moved work greater offshore, so greater offshore leverage in some of the areas that we have been working on. Our smaller geographies have registered much better than company average growth, so we are improving scale in some of these operations. And in a muted quarter, we obviously have focused on cost and managed it. So it's been a very broad-based margin management, and we are fairly happy about that.
Is this sort of improvement in realization sustainable in the quarters to come, or is it sort of one-off, or can you give us some outlook on that?
So we did a fairly decent one last quarter, and we followed up with a strong one this quarter.
So next quarter will be better?
If it could be traced that way, it will be great. But let me put it this way. We have always maintained that the pricing environment is quite stable. And there is a bit of a shift towards newer service lines, which also comes through. But this is also a factor of the number of working days and various other elements. So there is a volatility. Okay. But I think in past periods, we have discussed with you and on this whole issue.
Most of this has come on the back of improvement or higher fixed price contracts realization?
Not necessarily. It appears on both sides.
So what has prompted this improvement in realizations?
As I said, some of it is service line mix changes because newer services in the same larger service line, newer services attract better price points. Okay. Some of it is related to what would I say? Greater penetration in the better paying geographies. So some geographies have a better realization side. So it's a mix of everything. It's not just based on one.
So therefore, again, I ask you, sustainable over the next few quarters? Can you continue to improve on this, or do you expect that you sort of...
The pricing environment, as I maintained in the past, is fairly sustainable.
Yeah,
right? Okay. The Q-on-Q realization movement is a more volatile one. But for the full year, actually our realization has come in almost flat. Slightly actually positive, 0.1 kind of positive, which goes back to our whole discussion in the past also, where we have been maintaining that we see a fairly stable pricing environment. Yeah. So that we are confident about next year also.
In the last year, in FY15, I think in the second quarter, Rajesh, second or third quarter, you were very candid in pointing out that the environment is not looking good at all. And I think maybe that was probably the first time that we heard management say, look, this year may not turn out to be what we had anticipated at the beginning of the year, right? I'm asking you for the same candor at this point in time to tell me whether FY16, is going to be more of the same when compared to FY15, or is it going to be an improvement? Can we go back to FY14 levels at least?
I'll answer that, but let me frame what we said in the middle of last year.
Okay.
In the beginning of the year, we had come out and made certain statements, and based on what we expected and what we thought. In the middle of the year, when we saw that the momentum was not at the level that we had expected, we had pointed out that it's likely to be slightly muted compared to what we had started the year with. But that's not to take away from the fact that it's been a phenomenal year, because Q1, Q2 were really outstanding, and we have ended the year with 15% growth, which
constant
is right.
17%
constant currency, 15% on dollar terms, which is right way up there in terms of everything. So it has to be seen in the context of what we said earlier.
Sure, I understand that.
Within that context, given our experience last year, we don't want to comment too early about the year. But let me put it this way. We are going into FY16 in a scenario which is very similar to the way we went into FY15. The overall business environment is positive. There is a technology imperative. There's a proven technology out there which is getting well accepted in our client base. Our overall client ecosystem is fairly strong financially, so it does have the capacity to invest. There is a technology imperative to start an investment cycle. Whether the investment cycle will kick in or not is something that we can't predict, but we are positioned for participation in that investment cycle, and we think we are positioned very strongly. So we don't want to comment about how it will turn out, but it is.
So you feel just as optimistic about FY16 as you did about FY15, you just don't want to say it because FY15 turned out to be different?
We are as optimistic.
Yeah, just as optimistic. Last year, same time, you were just this optimistic.
The environment that we see is no different from the environment that we saw then. right?
Okay, I get that. I'm going to come back to you in a little bit for a little bit more conversation on margins, on investment. But before that, Ajoy, the quarter's been difficult on utilization. We've seen a decline. It's been very difficult on attrition. We've seen a big move up, 14.9%. Are you having people problems at TCS?
No, not really. Utilization also, if you look at the overall yearly utilization, including trainees, there's a 5% plus jump as compared to last year. And if I look at the utilization for this quarter, it's very similar to last quarter. There is a slight dip as far as quarter to quarter is concerned. And that also depends on the fact as to what is the number that you have been hiring in this in a specific quarter, right? Because the moment you get some of the people in, they will not be immediately billable. So that takes time. This is a capacity creation. So these are the factors. Attrition definitely is higher, as you pointed out. Yeah. It's about 14.9% compared to where we were as far as last year is concerned. Yeah. So from that point of view, during this year it's gone up. And
how do you fix that?
Yeah, and
it
is, and it's not that it has gone up suddenly. It's every quarter's been inching up, and we have talked about it in our previous interactions also.
Why is that happening? Is it more competitive pressure simply?
It's primarily the overall job market. If I get into the job sites and if I look at the kind of opportunities available in the market today, there are phenomenal opportunities for people. Okay, so at this point in time, what everybody is looking at is how do we contain that particular attrition? How do we give opportunities to our people so that they get to switch from technology to technology? They have a proper career path, career plan. And the other factor that comes in our industry is that our Gen Y population is about 80%. And as we know, this generation wants everything as of today. They don't want to wait for something. So that's an HR challenge, right? As to how do we communicate with them, how do we have them?
That hasn't changed dramatically in the last 1 year, so it can't be a new challenge in any fashion.
Exactly. So that is why it's been it's not that it has suddenly gone up. Attrition has been going up.
What is your expectation on what the attrition numbers will look like in the next few quarters?
See, what we are factoring in is that we will definitely try to bring it down, and that is what we have factored in when we have announced our hiring that we want to do next year. So exactly it may not happen in Q1 because Q1 and Q2, as we know, is traditionally more cyclical in nature, because this is the time when people leave for higher studies and those kind of factors come in and play as far as attrition is concerned. But at a yearly level,
what is the numbers that you're expecting to hire next year?
The number that that's 60,000.
60,000.
Total gross addition will be 60,000.
Okay.
And in relation to that, as far as the campus hiring is concerned, we have already done 35,000 offers.
Okay. Rajesh, coming back a little bit to some more color on, how margins will move from here onwards. What is your expectation for FY16 in terms of margins? And also if you can offer us some more insight into how investments will pan out as the focus on newer businesses like digital, sort of gets accentuated.
So, in terms of investments, we will strongly support whatever is on the ground. So we have invested into various geographies. We have invested into new service lines, into some of the product platforms that Chandra has been speaking about. And we have been early investors in the whole digital space, and that will continue. The joker in the pack is currency.
Which is not in anybody's control or predictable in any fashion.
So within keep that aside, we are fairly confident about this 26 to 28 band. I think we have the headroom required. We are in the middle of the band, so we have the headroom required, and we are confident about it. If the currency situation dramatically changes or settles down at a very low base, and we see our margin band being breached structurally, then we'll talk about it.
Is there any way to link, if the currency moved X%, then you would, that would be a big enough move for you to rethink this 26 to 28%. Is there any such linear link that we can try?
No, we don't want to maintain that kind of a clinical one, because I don't think it's when we look at Europe, which is where the real currency action is, we're fairly confident, fairly happy with where we are. It's a very large market, structurally very strong market, today going through a weak point, and we're building out beachheads in very important markets, which will provide us very good business over a long term, right? So we calibrate both based on what the headroom is available as well as on the strategic imperative and the opportunity that is on the ground. So we don't want to have artificial lines.
Okay.
And
a weaker euro, has it sort of helped your competitors, especially your big European competitors, and therefore allowed, I mean, is it causing shifts in the market share position in any fashion that we should be aware or concerned of?
No, what we are offering into that market is a solution capability, both from a technology perspective as well as from an optimization perspective, which the local competition is structurally not capable of offering.
Okay.
So yes, some amount of price differential comes in, but and that will have its impact on our financials, etc. But otherwise, structural competitiveness wise, I think more and more clients now realize that this story is not just about cost leverage. It's a larger story. We offer them flexibility and agility that they did not have. We offer them a global solution base which they did not have, which is why we're very happy with the progress that we're making there. And I don't see us throttling back on that just because of the currency situation.
So what would you flag off as the key challenges in FY16 outside of currency? I mean, that's the one that we're all anticipating, linked to what the Fed does, etc. I won't get into that conversation. But besides that, what's on your map of challenges for the year to come?
Besides that, actually, it's a very good environment. So if you look at it, even if you look at this quarter's performance, see, individual vertical industry volatility, leave that aside. Energy, we know that it was a totally black swan event, right? And telecom, we think structurally that industry is likely to remain volatile.
Right.
If you take those two out, the rest of the industry lines have actually performed very well. So overall, it's a market with a strong base and an optimistic tone, with volatility coming in and pulling it down incrementally. So can the volatility spread? Potentially, yes, but it's very difficult to predict that. And if that does not happen, we are in a good environment.
Big deals,
Big
spends, are they all looking more promising this year than they have in the last?
Absolutely. Our deal pipeline is strong. We are announcing good wins. If you look at our client metrics, if you see, I mean, we have added close to 90 new customers in that 1 million band. 5 new customers, or not 5 new, 5 customers are moved into the 100 million plus. So we're exiting with 29 customers spending more than 100 million with us. Now, all of those, so if you go down beyond that, the Q on Q ticker, the structural elements are all very strong and positive.
Okay.
So we need to see whether the trend line will get broken upwards based on the investment cycle.
Okay, fair enough. So Ajoy, quick final question to you. Challenges for FY15 outside of attrition, which you said you're going to be able to fix in the next couple of quarters.
Yeah. See, challenges are pretty similar to what we have had before.
Sure.
One is, of course, the scale. Second is the diversity. We have 122 nationalities. And women, as you know, we are the largest employer of women at this point in time. So managing that diversity. Third is this whole technology shift, what we have been into for the last 4 years, and we are saying default is digital. So how do you skill and reskill such a large workforce? It's 300,000, 320,000 at this point in time. And these are typically the challenges. And we are geared up for it. We are reimagining our own processes, the way we are providing our learning and development kind of opportunity to our people. So the whole digitization is being used. Anytime, anywhere learning. So these are the focus areas as we go forward.
5 minutes yesterday when there was, I think, not a single person in this country who didn't want to be a TCS employee. And that was when you announced your one-time bonus.
Yes,
so
right.
What a lovely move and a nice way to say thank you to your people.
Exactly.
Gentlemen, thank you. On that note, thank you very much for joining us today and all the best for FY16.
Thank you.
Thank you.